Hello, chart watchers, and welcome to this Tuesday, February 26, 2019 Market Watchers live show with your hosts, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, we're seeing a little bit of mixed action today. Not too bad, though, off the selling from yesterday, the reversal anyway yesterday. Dow Jones Industrial average currently down 10 points. The S&P 500 up 1 2/3. The NASDAQ down 3 1/3. And the Russell 2000 down nearly 6 points today, actually lagging for the second day in a row, which is notable. It has been a leader. 10-year Treasury yield down 2.5 basis points today, back down to 2.65%, and once again threatening this 2.63 area of support. Volatility index is down fractionally, down 0.08. Still a little bit below the 15 level, but it has been moving slightly higher the last couple of days. Energy leading the action today to the upside, and technology right behind, two pretty strong groups, relatively speaking. Utilities struggling today. It's kind of unusual. Normally when you see the 10-year Treasury yield down, you see the utilities area up, but that is not the case today. Utilities lagging. Home improvements, as you might expect, having a rough day after Home Depot's quarterly results disappointed traders. There was a slight lowering of guidance going forward. Both Home Improvements and Home Depot, you can see, did sell off at the open, although both have recovered off of their earlier lows, and that's been typical of the market over the past 2 months or so. Caterpillar got downgraded earlier today. You can see also taking a hit, down more than $4, but holding up above the breakout level at about 137. Had a double top there in January. We made that breakout on increasing volume about a week ago. Got up over 140, and with the downgrade today, we are back down to a key support level. So far, holding on to important technical support, in my opinion. All right, Erin, it is Tuesday. Anything warming up out there?
Yesterday, I think we actually got above 65. So it's been, actually, I read an article that it has been the coldest February in like 60 years. And we actually set a new record in that all of February, Los Angeles never hit over 69 degrees for a whole month. And that's never happened for a February ever in history since 1870, whatever, since we have been tracking it. So it has been cold. I'm not exaggerating. I really am not. And especially for us Southern Californians, really tough to take all that cold weather.
Yeah, weather is a lot like stock market. It's all relative.
There you go. See, you're right there getting started into my workshop right there.
Exactly. I'm sure we have a lot of listeners around, especially those to the north of us in Canada, that are thinking, wow, hasn't gone over 69. What a shame.
I know, right?
They've been looking at snow for the past 4 months, 3 or 4 months, and can't wait to see a little green out there. So it is truly all relative. But if you're used to the warmth, I've got family down in Florida, and they're the same way. If it's all of a sudden in the 60s, it's like horrible. And you go to the Northeast, and 60s would feel like, summertime at this point, this time of the year.
Yeah. Hey, when I lived in Ohio and New Jersey, when it would hit over 50 degrees, we were like pulling out our T-shirts because, we'd been dealing with cold weather for so long, and you're used to it. I'm not used to it anymore. That's why I live here. I'm getting old. I need good weather.
Yeah. Since 2009, I've moved one state further south now 3 times. I've gone to Virginia, then I went to North Carolina, now I'm in South Carolina, and it's still not warm enough for me. So Georgia, here we come.
All right, everybody in Georgia, you might want to think about that.
Exactly. I may bring down home values. Anyhow, we got a busy day lined up, so let's get to it.
Indeed, we do. This coming week is looking good. Tomorrow we have market timer Tim Ord of the Ord Oracle. And then Tom is going to do the March seasonality report on Thursday. And then you're going to have a workshop next Tuesday. So you're going to have to start thinking about that. I've got mine today, of course. And that is going to start our day. Milan Vashnu is going to be here with us on the following Thursday. Well, it looks like Wednesday. He's actually a new blogger. He'll be blogging for us about the India stock markets. So should be interesting to talk to him. Today's agenda, yes, we are starting Relatively Speaking, which is going to be my workshop. We'll do that after the technical news. 10 and 10, our very first symbol is going to be Cypress Semiconductor, CY, if you'd like to go check out that chart before Tom does. And then Tom is going to finish off with a segment called Tops and Bottoms. And I don't think we're talking about clothing, are we?
No, we are not.
Okay. Yeah, I was wondering if we were looking at some fashion combinations there. All right, well, let's go ahead and get started, Tom. Technical news.
Yeah, I would never be confused with a host of a fashion show, trust me. All right, let's take a look at what's going on. You can see on your screen there some economic reports out earlier today. Housing starts came in way below expectations. Building permits, however, came in better than expectations. I looked just a couple minutes ago, and the home construction group was down about 1% today. So not really that bad considering the numbers that came in, because in addition to the housing starts being weak, you can see December Case-Shiller home price index came in half of what was expected, rising just 0.2% instead of 0.4. And then the December FHFA house price index also came in just slightly below expectations. So really not very good news. But a couple things here. Number one, we're looking at December data, and we're into February, getting ready to head into March. So a lot of this housing data comes in. It's very much lagging in terms of the fundamental news that comes in. The market looks ahead. So I'm not too surprised that the home construction group is kind of shrugging off some of this bad news. The other thing to keep in mind is building permits are not required around some parts of the country. So when you get a better than expected number in building permits, you can assume that the number actually is even better than that. And so I think a little bit of some mixed numbers here in this report. And at 10 a.m. this morning, we had February consumer confidence out. A really strong number this morning, came in 131.4, and the market only expecting 125.0. So a pretty strong beat there. As we take a look at the 10-year Treasury yield, you can see, though, we are moving lower. I'm sure that headline news on the home construction numbers not very good. Building permits, the exception. There. But 10-year Treasury yield currently down 2.5 basis points, 2.65%, and that downtrend just continues. In my blog this morning, I really wrote about two things that are bothering me still about the market. For the most part, I'm not going to argue with the uptrend and what the market's been doing, but there are two things that I think I struggle with. Number one is this 10-year Treasury yield just not moving to the upside. I know there was a question yesterday I didn't get to, but the question was, and I'm paraphrasing here a little bit, but why essentially does it matter with what the 10-year Treasury yield is doing, and how does that impact equity prices? Well, you have to just realize that you've got a lot of portfolio managers, hedge fund managers, and so forth that are looking at their investments, and they allocate between bonds and stocks. And so I'm really talking about the allocation. New money coming into stocks, new money coming into bonds. We see that all the time. But when the economy starts to look better, there will be this repositioning between either money going from bonds to stocks or stocks to bonds, depending on how folks feel about the future economic strength ahead. Are we going to strengthen, or are we going to weaken? And so move higher in the 10-year Treasury yield can be a signal from the bond market that it's expecting stronger economic growth. And when you see that, and you see the Treasury yield moving higher, the only way the Treasury yield moves higher is if you see selling in Treasuries. So it's the selling of Treasuries, the lower Treasury prices, that drive the yield higher. There's always that 100% inverse relationship. So you've always got prices going in one direction, yield going in the other. So when the yield's going up, it means money's coming out of Treasuries. And if the reason that money's coming out of Treasuries is because of the anticipation of higher growth, economic growth, then that money normally rotates over into the stock market. And if I have time later, maybe what I'll do is I'll pull up a chart. If you look at the yield versus the S&P 500 over a long period of time, you'll see that there is a fairly strong positive correlation between the direction of the yield and the direction of the S&P 500 over short periods of time, not long periods of time. But anyway, a little bit of extra information there, but I did want to answer that question. And so let's take a look at some earnings. There were a number of earnings out last night and this morning. Some of the key ones that are showing up on your screen there. Etsy came out with another big report. They did post higher than expected revenues and earnings per share, and also raised guidance. Home Depot, you can see, beat on the bottom line, but they missed on revenues, and then they lowered guidance. So not very good there. AutoZone, you can see, with an easy beat after the bell today. We got a number of stocks coming up reporting. I think there were over 200 companies still reporting, I think, tonight, tomorrow, or well, today, tomorrow, and Thursday. So things have not completely settled down yet. We're not getting as many of the big names, but we're still seeing a lot of earnings reports coming out. Okay, let's take a look first at Home Depot. And Home Depot did come out with some numbers that were a little disappointing, no doubt about it. They matched, or actually missed, on their revenues. They weren't that far short, $26.49 billion versus $26.57 billion. They did beat, as I mentioned, on the bottom line, $2.25 versus $2.16. They guided their fiscal year 20 EPS lower, revenues in line. So anyway, the stock gaps down, but so far trying to print a hammer on very heavy volume, trying to keep this uptrend intact. I think a close back above the 20-day moving average would certainly be much more bullish than the alternative. Taking a look at, let's take a look at Etsy, ETSY, because this is a company that has reported very strongly in the past, has been in a nice uptrend. Mentioned yesterday, we talked about some stocks that were heading into earnings last night, and Etsy was one that we talked about being a very, very solid performer, but it's been in a weak group. So kind of, you have to be a little cautious with that. But this is why the company has been such a great relative performer. They came in, they beat expectations on the top line, $200 million in revenue. Expectations were $194.8 million. Bottom line, 32 cents, expecting 28 cents. And then they guided their fiscal year 19 revenues higher. Look at the volume coming in already, nearly 15 million shares. We're not even the halfway point of the day. And big gap up after consolidation. I suspect we will be seeing higher prices on Etsy down the road. A couple of other earnings reports that we talked about yesterday after the close that, well, let's just pull them up. One was OKE, and I was expecting a decent report. That's what we talked about toward the end of the session yesterday. I expected a decent report. They did miss by 4 cents, but the stock is holding up after trading above its 20-day moving average for about 8 weeks. It is now just testing it for the first time. So far, holding up. I'm a little nervous, though, because we do have higher prices and a lower PPO, so we want to be careful in the event that we break down below that 20-day moving average, because we could be looking at a rising 50-day test. Mosaic, MOS. This one was looking iffy. The group was very strong, but this stock on a relative basis, if you recall, had been drifting lower. They did come out. They beat top line, beat bottom line. They guided in line, and it gapped up, traded higher earlier, and then came back down, went quite a bit lower, now coming back. A lot of indecision on this stock after earnings. And that kind of, well, it doesn't surprise me, given the way the stock looked. I said yesterday, I think the word I used was iffy. It just kind of looked a little, I don't know, iffy heading into earnings. And I think even after earnings, I think we've got traders wondering what to do with it. ATH, I thought, was a questionable stock heading into earnings. They did come out a little bit better than expected, gapped up, but you can see reversing. This has not been a very good relative performer, and that's why I was a little nervous. Of course, Etsy, we talked about. That was one that I had mentioned was a great performing stock in a weak industry. And the last one was ALSN. This is Allison Transmission. I was expecting a strong report. They did beat, but they lowered their outlook, and that's what caused the move to the downside. But look at that bounce off the 20-day and a move right back up to new highs, up nearly 4% today. Pretty nice reaction off of a report that included a little bit of downside guidance. All right, Erin, I know you got some upgrades, downgrades, and a great workshop, so I'll let you take it away.
All right, yeah, let's get this started. Hold on here. All right, so we're going to start with those upgrades and downgrades. Actually, it was interesting today because there weren't as many upgrades as I would have expected. We actually had a very small amount, so I only was able to even pick out 3 that I thought were interesting, and I'm only going to talk about 2 of them. And we will start with Ally Financial. And you can see it is up 1.7%, looks like, on this upgrade from Sandler O'Neill. They moved it from a hold to a buy, and they moved their price target from $29 up to $33. I would say that I don't think it's going to hit that level. I don't even think it'll hit that $29 level for a little while. And I say that because of the PMO sell signal in overbought territory. I mean, this is pretty much, I mean, you look at this, just like you get a buy signal in oversold territory like this, they're generally pretty much right on. And so I would be expecting at least a test down here of the $26 level. So despite the upgrade, I'd probably keep my hands off of it for a little while. All right, Exact Sciences. Goldman upgraded it today from a neutral to a buy, and they moved their price target from $85 to $120. Makes sense since they already hit 85. So at this point, we're looking at $120 as their target. We've got a really nice breakout here. It is in healthcare, and there's been some rumblings, at least today. I guess the healthcare industry, a lot of people are up on Capitol Hill today. And so there's a little rumblings that maybe the healthcare industry is going to get a little soft and maybe have some problems. But I think Exact Sciences actually looks pretty good. And I would move this one to a weekly. There you go. And you can see that it's continuing to just make new highs. I wouldn't say this is a parabolic move. I think it's a pretty nice move to the upside, but you can see that the rising trend channel we had here, price is busted out above that. So it is getting a little bit on the overbought side. But I think the PMO looks fairly good there. CenturyLink. All right. Now we're moving into the downgrades. B of A Merrill downgraded CenturyLink from a buy to a neutral and changed its price target. Well, it says $14, but we know we've already moved well below that. So I guess their idea is that we might get back up to 14, but that's about it. I could see that. The PMO is looking pretty ugly. It is below the zero line. It's declining, but I see a possibility here because there is this declining wedge. Those are bullish formations, and we have hit some really important support right here from that low we had just a week and a half ago, it looks like. So something to consider. Let's see here. Next one up, Foot Locker was downgraded today by Pivotal Research from a buy to a hold. They moved their price target to $64. You can see we've got a declining tops on the PMO, rising tops on price. That's a negative divergence. Don't like that. I would say, though, if we can hold this area of support, which lines up back to that June top and our top back in January, seems like a pretty important area of support. So I would want to see that hold, and then maybe we could get that bounce to the upside. But I'm not really thrilled based on the PMO. I don't think the PMO looks really healthy enough. But you do have a good looking scooter, and the OBV did manage to get back up to highs we saw back here. So that's a good thing. We're seeing volume on the move with price, so that works out pretty good. But on the downgrade, I know I would be a little bit cautious about that one. Old Dominion was downgraded today by B of A Merrill from a buy to a neutral. They moved their price target to $158, so about up here. I do see the 5,200-day EMA positive crossover. And that tells me that ODFL, Old Dominion, has moved from a bear market configuration that started back here in November into a bull market configuration. Now, this doesn't mean that it's just going to continue higher. What it tells us, though, is when we get formations, like if you look here in the thumbnail, a flag, which is a bullish formation, the expectation actually is for that to execute now because we do have a bull market configuration. However, we do see the PMO is quite overbought. And while we do see readings back here from -6, if we do a quick little check here, go up to about 5 years, we'll be able to see what the actual zone is for the PMO. And as you can see, it is very overbought in my opinion because the zone looks like 5 to -5. So even though we stretch down into that -6 area, I would say we're really getting up towards that overbought territory. So I would be cautious with this one as well. And Palo Alto Networks was downgraded today by Northland Capital from an outperform to a market perform. They have moved their price target to 240, which, wow, is right up to where I think the next level of resistance is. You could see the PMO was starting to turn over a bit, even though price was rising. That to me is a warning flag. So I would suggest that we're going to hit that level at 240 and likely be turned away because of the fact we have an overbought PMO that has already started to decelerate and move toward, move lower. We do have what I usually call a bull kiss here, though, where we got a little bit of a fake out without that negative crossover, but I'm not impressed, mainly because the PMO is at the top of its range. And that's all I had for the upgrades and downgrades. A couple of other, Exact Sciences was upgraded today, and other downgrades, Caterpillar, I know that you looked at that one, Tom. One Oak was downgraded today, Kraft Heinz, and then Spark Therapeutics, ONCE, was downgraded twice today. So interesting chart there, but I didn't want to show it because it was giant gaps, and giant gaps aren't very interesting to me ultimately to talk about. So those are the ones we have. So now I'm going to go ahead and we will move into my workshop. Alrighty. So first of all, let's go ahead and get back here. All right, here we go. So my name is Erin Swenlin, and I am going to be doing a workshop for you today called Relatively Speaking. And what I'm going to do is talk mainly about how we use relative strength and the different tools we can use, like the price relative tool and various price relative charts. I'm going to give Tom a little credit here when I get to some of the examples. So first of all, some of the things I'm going to cover is, of course, what is relative strength. We'll look at some of the indicators and tools that you can use to measure and find relative strength. Recommend you go ahead and take the poll if you're watching live today, because I will look at that after our workshop to see which tools you like to use. Price relative charts, I'm going to show you how to do those chart settings. We're going to look at performance charts, and I'll also cover RRG. So first of all, what is relative strength? Well, basically relative strength, you're comparing the performance of one security or index to another. So there are different ways that we can do that. And I'm going to show you a couple of them. What sometimes people get confused about is we talk about internal strength. And we do talk about relative strength on a single chart. And so that can be a little bit confusing. So hopefully I'll be able to clear that up as we go along. So how are the different ways we can measure relative strength? Well, some of you may not be aware. Oops, hang on here. Some of you may not be aware, but you can use the PMO, the PPO, and I'll talk a little bit about the one that's missing here. And you can use those. They are on one chart, and each of them measure the internal strength of that particular security. But they also have the added benefit that because they are what I like to call normalized, in that they take price into account, but they're not subject to what the price level is between one security and another. So using the PMO and PPO, you can actually compare those readings from, say, an Amazon chart to a Ford Motor Company chart, even though the price differences are huge. It does not matter because of the way these indicators are structured. You can use them and compare their readings across other securities. So we'll talk a little bit more about that. The stock charts technical rank, excellent tool. We'll talk a little bit more about how that is calculated and how we can use that on just one chart to see how what kind of relative strength our ETF or stocks have. I'll talk a little bit about using the price relative tool. And this is one of the settings that you can use in the workbench. I'll show you the various ways you can do that, give you some samples. We'll look at perf charts, is what we call them, performance charts. There's a couple of ways to use those. And then I will finish off just showing you a little bit about relative rotation graphs. This is a lot of stuff to cover in half an hour. So I probably will be, kind of brushing over a few of these. So just bear with me. All right. So you saw on that chart probably that I did leave off the RSI. And so, what about the RSI? Why did she leave it off? Well, there's a lot of confusion sometimes because when we say relative strength index, when you have that actually on a chart, it's not an indication on that chart of the relative strength among other securities. It's an internal relative strength. Where is that particular security in regards to its price level? And is it overbought or oversold? So you're looking at the RSI, but it's just for that particular security. And the PMO and PPO, when you have those on the chart, same deal. They're really measuring what's going on with that particular security. But the benefit is that you can compare their readings, like I was talking about previously. So you measure, the RSI, and honestly, the PMO is very similar in that they measure internal strength, and they do that by looking at the speed, momentum of the changes in price movement. But they're not bounded by or unbounded by the fact you're not taking those price levels into comparison, remember, so you can compare securities that are way different in what their price values are. And so the RSI does that as well. But like I said right here, it says doesn't compare security to security. On your chart, when you have an RSI reading, it's not taking into account any other security. So the relative strength index, though it's called relative strength, it's not really relative strength among its peers necessarily. It's not comparing that. It's only doing its calculation on that one security. And as I said, the same does go for the PMO and the PPO. So here are a couple of the tools, and we're going to go over a few of these. How to compare the PMO and PPO RSI readings. There's a couple ways to do it. The scooter ranking within a universe, I'll show you how that works. The price relative settings that you can put on your chart are another tool that you can use. And then, like I said, we'll look at the perf charts and the various settings, and then I will cover the RRG. Now, one of the ones I left off that also you may have kind of question is the MACD. Why isn't the MACD on there? Well, the MACD is, it's unbounded for one thing, and you can't compare it from security to security because of that fact. And here's a really good example of one of the reasons you can't. So you can get all kinds of MACD readings we don't actually look at what the value is of the MACD. Generally, we're mainly looking at what it's doing. But here's the problem. When you go to a daily MACD, now just from the upgrades, downgrades I just did, when I stretched out the daily chart, you can see with the PMO, you can see a defined range that it typically moves in. But the MACD, because it isn't, because it is subject to the price level and it's unbounded, basically, when you go back in time, the readings kind of flatten out. So it's a lot better to use the PMO. The PPO works similarly. It just takes the MACD and makes it a percentage change, which is why you're able to compare the PPO across securities as far as the relative strength goes. All right, so I want to go show you a couple of examples. So let's go ahead and move over here. And the first thing I'm going to show you is how, you can look at the RSI, PMO, PPO, and scooter and compare these values to another chart. That's the beauty of this. Remember, you've got values here, but you can compare them. With the RSI, we're always looking at a particular range, and you can compare where this is in its range to another security and where it is in its range. Is it overbought relatively to the other security, or is it oversold? It's a good way to check between securities for that. PMO, you actually are going to look at those readings and you're going to compare them to the readings of the other security. And like I said, I'll show you that a little bit. PPO is the same thing. You can compare the actual readings from one chart to another. And then here's that scooter. And the scooter is comparing this security, General Electric, to all of the members in its universe. So this is a relative strength reading on your single chart. This is telling you what the relative strength is in comparison to what's going on with all of the other securities. You know, where does it rank from 0 to 100 in comparison to the other securities that are in its domain? Okay. Get my. Alrighty. All right, so we're going to look at another example here. If I can get my mouse to work here. Oh, I almost saw you. Let's try it this way. Okay, you can go to the chart school and you'll be able to find a lot of what we're looking at here. Okay, so here's the General Electric chart, and we can see the values of the RSI and the PMO and the PPO. Let's look at the same for Amazon. And you can tell, okay, GE's at $10.50. Amazon is in, you know, the $1,600 range. So, you know, normally you wouldn't really be able to compare those because of the price levels. It just doesn't make sense. But we can compare the RSI in terms of, it's at 49.25. It's right in the middle of its overbought, oversold zone. And remember, GE was near the top. We have the PMO is at 0.5. GE's was 6.13. So relatively speaking, General Electric, as far as price momentum is concerned, is more healthy. You have the PPO at 0.0005, and then we can compare that to the other one. You can see right back there was 6.6. The PPO 4.017. So you can see that again, there's a difference in the internal strength between the two. You can also look at the scooter, like I said, but we don't really compare it to each other necessarily. We don't have to, because it's already being compared among the universe of stocks that it is in. Okay, so let's look at, there's the RSI. You can see this in chart school. All right, and I also have the stock charts technical rank here. And this is what I mean by relatively being able to see the relative strength of a indicator using this, or of a stock using the scooter rank, the stock charts technical rank. And it's the way it's calculated is this way. And you're going to get a value, and then that value is compared with all of the stocks within its universe. So let's go down here. So here you have the large caps. You've got your scooters. We make the comparison to see what the values are, and then that can tell you how it is in comparison to the other large cap stocks. And that's how you can use that as well. So you can get that relative strength that way. All right. Let us move on. Okay, so the next one I'm going to show you is, I talked about how we can compare these to each other. One of the things that I like to do when I want to compare the PMO, because that's the one I use, amongst a bunch of peers, I can do it with a scan sort, and a lot of people may not be aware that this exists. So I'm going to take us to the member dashboard, and I'm just going to take a predefined scan. So we'll come down here to predefined scans. And I'm just going to pick one. Let's pick strong volume gainers. There are about 61 of those. So I'm going to call all those up. I'm going to save them into my scan dump, which is my transient chart list. I never plan on doing anything in there that I want to keep because I constantly am dumping scan results into it. Kind of a nice little thing to think about or use. So what I do to compare PMO values is I come up here and I move this into a candle glance view. There you go. And I have the PMO on my candle glance, but what we're going to look at is how we can sort them by the PMO. Now I have to change I have a custom style, as you can see, the colors, the way I have my EMAs on it, the length of time is 6 months. I have my own little candle glance that I like to use, my own custom style. You can do the same. All you have to do is set up what you would like your candle glance chart to look like on the workbench, and then you save that chart style as candle glance. And then every time you pull up your candle glance, you're going to see the same style, your custom style. But in order to do sorts, we have to move into, we have to give it we have to move out of a custom style. So I'm going to go to the 6 months because that's what I usually look at for my candle glance charts. And now I'm going to add an indicator to sort by. All right. Now you can do MACD, like I said, but you know, there's you can't, I mean, there's no relative strength comparisons there with the readings. So you can do it with the PMO, the PPO, and the RSI. Those are the ones that I would recommend. The scooter line, you could do that as well if you wanted to sort by that. But I want to sort by the PMO. So I've got that in here. It automatically defaults to what our default is, and that's the one I like to use. I'm an intermediate term trader. That suits me. And now I want to sort it. And I'm going to do a descending because I want to have the strongest ones on the top. There we go. So now I've sorted it by the PMO. And now of those strong volume gainers, these are the most, the ones that are relatively stronger than the others because they have very high PMO readings. And so you can see that by doing this sort, now you can look at the stronger candidates first. If you wanted to, maybe if you're bottom feeding, you could do the ascending version, show the worst PMO values. And maybe when you're in here, you would find something that might be interesting. For example, here's a PMO buy signal. It is at minus 21 as far as its PMO value goes, but it's just got a buy signal. It might be something to look at. It's in the $2 range, so I would stay away from that. But I'm just showing you an example how you can find use relative strength with the candle glance. And like I said, you can change it, and we can make it the RSI if we want, and we'll do it in descending. Let's find those strong ones first here. Of course, they're going to be the very overbought ones. There you go, because they have the highest RSI readings. So now you have an idea of which stocks are more overbought than the others. And if we do it the other direction, now we can look at the ones that are more oversold based on their RSI. And you can tell because they're all, you've got your little red mountains here on the bottom. So another way that you can do relative strength analysis using just the PMO, the RSI, or the PPO. And like I said, when you're looking at them individually on a chart, they're really telling you about what's going on with that particular stock. I use the PMO, as an internal strength. It tells me if internal strength is good based on the way it's oscillating and what it's doing. I think you could do the same with the PPO. I would look for divergences. And you can see with the PPO, we have a little bit different here. We have declining tops here, and we have flat to rising tops right in here. And you can see that that gives you a little different view of what's going on as far as what the price tops are doing, if we're getting a confirmation or if we're getting a negative, a divergence, a negative divergence. So in this case, we were looking at a bullish confirmation because these price tops were rising. Over here, we have a negative divergence. So that's telling you that to expect downside movement. Well, we got some. This is another reason I just prefer the PMO. I think the divergences tend to be a little bit more clear on them. I like the way they set up. In fact, as a quick little aside for us here, I will show you something. I think it was in our DP show from here. We compared, Carl and I compared some of these momentum oscillators and how they can be used. So I wanted to show you those charts because it's very, very interesting and gives you an idea of the differences that can be figured out from just looking and comparing those indicators. That's not the one I want. Well, we'll look at a different one here. Might as well give you a little bonus here. I'm not finding what I want. All right, well, the idea is that they do act differently. The PMO, the PPO, the MACD, OBV, even accumulation distribution, they all have different feels to them, I guess is what you could call it. And so they do different things. And so we look at the ones we like. Here we go. That's the chart I wanted. All right, here we go. So you can see that they react differently. And one of the things that Carl had noted was, again, these divergences a lot of times will be different. And, you know, you have to make those comparisons and decide which ones you like the best. And you can see also signals come in at different times based on which indicators you're using. And you can compare these across the board. So for example, that's the SPYs, PPOs, and RSI, and all of that. So let's look at XLP, for example. And you can see all of those as well on there. And we can make those comparisons between the two and look at the values of the PPO and the PMO. Not the MACD, remember. All right, so let's go ahead and look at some price relative, and then I'll show you a little bit more there. So I wanted to show you how to add price relative. So price relative is you're comparing the price directly with something else. And typically, when you add it, I'll show you what happens. I'll take the MO out for now. I'll take that one out. Price relative is right. Price performance. It's going to immediately do this for the S&P. But we usually, what we do is, and I know what Tom does also, is we use it as a price indicator. And then we can compare it with, you know, you can do industry groups, you can do whatever you'd like. And you just put a colon between the two. Don't we love autocorrect? So now we want to compare XLP. This doesn't have much to do. Well, let's do AMD. What am I thinking here? Wow, autocorrect is just so wonderful. Well, let's skip ahead. I'm going to show you Tom's relative chart because he knows how to use this tool to perfection, I would say. So when you use a price relative tool, you're comparing one security to a benchmark. So in this case, when we're looking at AMD, we're comparing it to its industry group. We're comparing it to what's going on with the S&P. We're comparing the industry group to what's going on with the S&P. So we can look at how the price performance is going on here using the price relative tool. Now, everybody always wants to know how to set those up. And here you go. Now, if you want to get a copy of the price relative chart, typically Tom will do one or two in the 10 and 10, and you can just copy it from there. But there's a couple of other ways to do this. And like I said, we did have the price performance right here, a perf chart. Alrighty. So here we're comparing it again with the S&P using the price performance. What I like to do, and this is where we're going to go into perf charts. This is the best tool to use for performance charts. And here is where you would put in all of the things you want to compare it to. So let's just pick, I don't know, pick a few stock symbols that we're thinking about here, just off of the top of my head here. Amazon, Facebook. All right, so now I've put all of these in here, and it, starting at whatever date it is, it shows you the percentage change, and you can see which one has performed better as far as all of these. So steel, obviously the worst performer of both over this 200-day period. AMD, obviously the best over this particular 200-day period. But we can move it around and see in 2017 what happened. Now, you don't have to just look at this like with the line charts. You can also do the up-down pairs with a histogram, and you can compare them that way. And again, you can compare the days and how long. So that is one way to do it. Another quick way to get a perf chart is clicking here. You want the perf chart of, let's say, Ford. There you go. It'll bring you right in there, and you can see that and go from there as far as selecting and using a perf chart. All right, so I think those were the main ones. I'm going to show you, we have RRG, of course. That's Julius. And RRG compares securities relatively and what their headings are. I recommend you check out that. So those are the main ones. Let's go ahead, and I want to take you over to our final look here. Okay. So here are the takeaways for you. Remember that relative strength is a comparison between one security and another. The relative strength index is just for that particular security when it is on the chart. You can compare the PMO, PPO readings and the RSI readings among other stocks. The price relative settings, I showed you how to use that for specific benchmarks. Price performance charts, they're good to measure among small groups. And then RRGs, you can use about 50 symbols to compare. So that's a way to do your comparisons with a lot more. And that's all I had for my relatively speaking workshop. So let's go ahead and pull up the poll, and we will see what relative strength measures that you use. All right. Now, I noticed there's, almost 80% have the PMO, PPO, and RSI readings. I'm curious, though, if they are talking about just having them on one chart, or if you're actually comparing the readings from chart to chart. I think RSI might be a place that a lot of people do that. Yeah, and the scooter, I think, is brilliant. That's a great way because you can see it on the chart, one. Price relative, we just showed you how to do that. RRGs, I love those. I don't really use a lot of perf charts for my analysis. I really, I look mostly at the scooter and the PMO ranks, and then as well, I use that price relative. So how about you, Tom?
Well, I definitely am a fan of the PPO, and I have RSI on my charts. I don't refer to it too often. Probably the time that I use the RSI the most is more for like a confirmation when I'm buying a stock. A lot of times I like to see that RSI down in the 40 to 50 zone because it at least tells me that the stock, looking back over the last 2 to 3 weeks, it is pulled back enough where it makes me feel a little bit better about getting in with limited downside risk. So I use the RSI occasionally to confirm, but mostly I work with the PPO. Stock charts technical rank, that developed by John Murphy. Enough said right there. Clearly that's something that you can use very, very quickly, and it's already developed for you. To just plot that on your chart. So certainly that is an easy indicator. I use it from time to time. I don't have it on my regular chart style, but it is something that I will refer to from time to time, and I do that here on Market Watchers Live. Price relative I use quite a bit, as you pointed out during your presentation. I do like to look at it relative to key benchmarks or other areas, other asset classes in the market, which I picked up from John Murphy in his books. And then the RRGs I've really been getting into more and more of late. Wrote my last Chart Watchers article about it. I've had it in my daily blog from time to time, and course, when we did the break it down segment, the last few break it down segments, we've used the relative rotation graphs, RRG charts, quite a bit. So, and I like you, I don't really use the perf charts much.
Yeah, I don't tend to use them. Sometimes I'll pull it up, on the sectors, maybe to just see what's been going on with them over time. But typically, no. But I think they certainly have their merits. It's just something I don't use on my own. And only 1% said that they don't use it at all. Well, hopefully after seeing the workshop, they might be a little bit more impressed and be interested in using it. I have to say, like I said, I added your chart style for the one. Because it's great. You can put everything on the one page. And while I don't call it up all the time, it's a really great tool to have, to be able to just look at as far as those benchmarks, knowing that industry group is lagging, knowing that stock is lagging within its industry group. All of that stuff is great information.
Yeah, I think if your goal is to outperform a benchmark, like the S&P 500, then I think it's a good idea to have those some kind of relative strength analysis that you do to be able to identify the areas of the market that you want to be invested in. Most of my trading, I normally am going to trade with the trend. And, Arthur writes about this a lot, but I think it's really important to kind of see the big picture, see where the money is rotating to, and then look in those areas, because I think you have a better chance of outperforming the S&P 500 if you're in an area of the market that is outperforming the S&P 500. It's not a slam dunk, and obviously you have underperformers within outperforming groups, and you also have outperformers within underperforming groups. But I think overall, you're likely to have much better results over the long term if you're trading within areas that are outperforming the S&P 500.
Indeed.
All right. Well, our goal going forward is to get that 1% number down to 0.
Yes, I think that is a very good goal to have.
That is a good goal.
All right. I do not have an RRG because, of course, I've been pontificating now for half an hour. So I'll let you get started on the one that we have. Go ahead and vote, guys, on which one you want to see as the second symbol, because whether we've looked at it yesterday or a week ago, it will be looked at. The rest I'll pick out from the group, and if we've seen it lately, I won't be doing it. So go on ahead. Cypress Semiconductor.
All right, let's start with Cypress. You did mention that I would show a relative rotation graph, or not a relative rotation graph, but my relative chart. And that's what I got here. So I'm going to first scroll down just so everyone can kind of look to see under the indicators how this is set up. So you can always come back here and look at the recording and check this out. But I like to, as my indicators, I like to see how the industry's doing. Dollar symbol, $, industry, and then dollar symbol, $, SPX, and then dollar industry, $, SPX. That will give you the setup that I have up here. Now, what I've said before, what I like to see is an industry group that's going higher, a stock relative to that industry group going higher, the stock relative to the S&P going higher, and the industry group relative to the S&P going higher. Now, what we're seeing with the semiconductors is they were lagging for a while, but I talk about change of character on charts, and I think that's what we have here in 2019 with the semis, at least for now. We've got the semis starting to turn up and trending higher relative to the S&P. You've got, in this case, CY, Cypress Semiconductor, turning up relative to the S&P and turning up relative to its peers. And there you can see the absolute strength in the semiconductor. So what we have is a stock that is starting to show a lot of relative strength. Now, we haven't cleared the prior highs. It's possible we roll back over. So I don't think you just blindly get into a stock like this and come back in 3 months and see how it's doing. I would continue to monitor it, because if the semiconductors roll over and we start to underperform again and Cypress can't hold on to support, this is a stock that I want to keep a stop in play. So I just highlighted a couple of key areas here. We made a breakout above about 1520 or so, and you can see that also lines up here with that gap down. Actually, the gap down was below 15, but we finished at about 1520, and then we gapped down on heavy volume again. Came up, you can see the hesitation around this 1520 area, and then we get the breakout with increasing volume. So the first pullback that I think is just a healthy, normal pullback would be to the 20-day moving average, which is at 1509, and this price support level, which is around 1520. Going back and testing that, I'm not upset about. I mean, obviously, you'd like to see your stock just go up every single day, but that would just be a normal pullback in an uptrend. So that would be the first level. Now, if we break down below that level and you start to see all these other lines continuing to move lower, that might be enough to get me out of the stock. Going down a little bit further, though, you can see the big volume that came in early February. I think that was earnings related. We gapped up above these prior highs, and we never went back down below this 14.5 area. So I think 14.5 is clearly my line in the sand on Cypress, and it could even be the 20-day, like I said, depending on what's going on down here. But this is definitely a chart that's improving, company that looks better on its technicals, and it's within a group that is improving as well.
All righty. Oh, my goodness, by a landslide. Our most popular request is gold, GLD.
GOLD?
No, GLD.
Oh, GLD. Okay, sorry.
Yes.
Well, part of it, the dollar has weakened over the last 7 or 8 days, and I think that is helping here. So let me pull up GLD, and you can see that the move up. I've said before, I think in the short term, GLD still remains fine. Long term, GLD has some issues, and I'm going to just show you. And again, I want to outperform the S&P 500. So what I'm going to do is I'm going to show you GLD relative to the S&P 500. We'll make this a weekly chart. We'll go back 10 years. And then I'm also down here instead of the RSI, let's bring up the US dollar. So for me, the problem with gold isn't so much what it's doing in the short term. The problem with gold is that the dollar has been in a long-term uptrend. And as long as the dollar remains in a long-term uptrend, I'm going to have problems being in gold because it has been in a long-term relative downtrend versus the S&P. Now we're looking at it. I mean, I could pull up, I'll come back to this chart. Let's take a look at the short-term chart, and you see this nice uptrend in gold. It looks really good, right? 2019, it continues pushing higher. Well, it's not really that good because if you're in it, in 2019, it's been going down relative to the S&P 500. So if you've got gold as part of your portfolio, you're underperforming, even though in the short term, it looks pretty good. So if we get a short-term breakdown in gold, that's when I would be very careful because you've got this long-term downtrend, and I'll go ahead and use this one to annotate. You've got a long-term downtrend in relative strength of gold right here. At the same time, you've got an uptrend that has been in play on the dollar. So if we go back and we connect that low right there with these other lows, I mean, you can see, I think we've got a pretty strong uptrend that remains in play. Yes, the dollar's weakened, but that came after a huge move to the upside. I think the overall trend is still higher in the dollar. And I think as a result, the overall relative trend in gold versus the S&P remains lower. So for that reason, I would stay away from gold. I don't think this is the right time. I think if the dollar breaks down, then you want to overweight gold. Until then, I would steer clear of gold.
All right. Let's see the next one. We did have a lot of ETFs, so I'm going to throw a couple at you here. The first one being the Consumer Discretionary ETF, the small cap one. So it's PSCD, the Invesco ETF.
Yeah, I mean, we're starting to see a bounce back in PSCD because we have seen small caps, outperform in 2019. So this has been pretty nice little rally here. And this is another one, I think, as long as we continue to hold on to key areas of support on pullbacks, then I'm fine with it. And here is one key area. I think this last breakout above the early February high now offers up support, which is almost perfectly intertwined here with the 20-day moving average. So I think as long as we stay above 61 on PSCD, I'm fine with it.
All righty. Let's see, next one up, like I said, another ETF for you, the biotech ETF XBI. What are you thinking of biotechs now?
Biotechs, I think, still are struggling on a relative basis. I do like the move up here yesterday, clearing that at the prior high, and you can see the PPO reacting nicely to the upside as well. I think 90 is going to be in an area to try to get through. Like that PSCD I was just looking at, the XBI has continued to hold on to its rising 20-day, but we want to see outperformance. So when I look at this, I'm looking at this reaction high back in October where we pulled back, and then you can see the lower lows, lower highs. Here was obviously a pretty big area. We've already cleared this one, and now we're trying to get through the second level up at around the $90 level. Good news is, like I said, we're holding on to the key area of support. Every time we pull back, you can see this 20-day moving average is holding. As long as that continues and you keep trending higher, I think I'm fine with the XBI.
All righty, let's see. Let's look at copper, SCCO.
All right, nice breakout above this high, well, multiple tops here around 34. That's where we had a gap resistance level. We've gone back up. We've tested. We had not been able to get through. Here was the gap down. Look at that volume on the huge gap down. Get all the way back up there, and this is the area where I've talked about this, where I would short. When I see a big move down, break down heavy volume, get back to the bottom of gap resistance, you can see then we go lower. We came back up. We tested that area early February, went back down, and now we've gotten through. And look at the volume on this push back to the upside. I think this is a change in character on Southern Copper's chart. And I don't like to chase, but a pullback, you've got some decent price support now at 34, and you've got the rising 20-day coming up just underneath at 33.65. So if we get into a period of some profit taking and the SCCO gets back down to around 34, 34 and a quarter, something like that, I would be much more interested in it.
All right, sounds good to me. For our friends in Canada, let's look at a bank, Bank of Nova Scotia, BNS.TO.
Yeah, they just reported earnings, and they did miss on top and bottom line, and you can see the negative reaction today. Also, the stock, as it was moving higher, it had higher prices, lower PPO, so you had a little bit of a negative divergence there. Well, you had a lot of a negative divergence, but keep in mind, though, that only takes into consideration price. Does not have anything to do with volume. So when I look at this, I see negative divergence, but on the recent breakout, you can see the volume's been pretty strong. So I don't know that I would have paid too much attention, honestly, to that negative divergence, but holding anything into earnings is always a crapshoot. I think that 73 and then even this breakout back here just above 72, I think that's going to be the two key levels on BNS as we go forward. So I'm just going to draw those lines in. So I think this pullback is back into an area where you certainly could buy. A test of that 50-day moving average is what I typically look for after the negative divergence prints. So I think 72, 72 and a quarter actually would be a pretty solid reward to risk entry into BNS.
All right. How about Beazer Homes? BZH.
All right. This is another one that, and I'm starting to see this a lot. I'm going to talk about it more in the tops and bottoms segment at the end of the show. But I'm starting to see more negative divergences. I mean, we've been in this uptrend now for quite a while, and I'm starting to see momentum slow in some areas. And while this isn't, a perfect negative divergence, I certainly think that you can clearly see higher prices. It looks like the PPO is just slightly lower, so a slight negative divergence. And then when I get that and a reversing candle, and that right there is a dark cloud cover candle, almost a bearish engulfing, doesn't quite make it. That's a dark cloud cover. Still reversing candle with a negative divergence. That is normally not a good combination. And you can see the stock has been struggling last couple of days. I believe you're going to find some really good support on BZH as it gets closer to 1130 to 1150. If it continues to decline, that is where I would look for a reversing candle.
All righty. Let's see the next one. This was actually a pretty popular request, which was NIO. I think that's what that was. Yes, NIO.
NIO.
Yeah, I've never even, I don't know, I've not heard of it, but
I am not familiar with it either, but clearly somebody's familiar with it because there are a lot of buyers taking a shot here. Multiple tops going over the last 6 months. You can see we kept struggling at about 840 to 850. Finally, we got the gap up yesterday. I don't know if that coincided with earnings or something, maybe today. But look at the volume picking up and the huge move to the upside. Here's the problem. If you jump in at 1017, if it goes back just for a normal test of the breakout level at around 850, 840, you're going to be down 17%, something like that. So I don't like to chase. I think that your key levels are support just below 850, and then your target up here at about 1260. At 1017, I don't know. I don't think it probably makes sense to jump in at this point, but it is one that I would keep an eye on. If you don't, if you like the exciting trades, this one definitely is going to provide some excitement. Not just the last couple of days, but I'm sure in the next few it will as well. I'm just not sure which direction the excitement's going to go. Near term, though, pulling back down closer to that 840, 850 level, I think gives you a better reward to risk.
All right. Also a popular request, Verizon. They're talking about the 50-day cross.
Okay. Well, that is a golden cross. It is a little bit of a lagging indicator because obviously you have to have some strength for a while before you'll get that 20 to move up through the 50. But in order to have a healthy chart, you need the 20 above the 50. I mean, you can see what happened with Verizon back in October and November. As long as the 20 stayed above the 50, we were fine. Once we struggled, went below it, that's when we had a lot of some anxious times in December and January. So this is a positive. But what I'm seeing more than anything is maybe just more sideways consolidation, which means these crossovers, these moving averages are not going to be as important. I'm just going to point out the key area of support and resistance that I would look for. 52.5 downside. And I'm going to say right about here, 58.25 upside. I think we're in a trading range. So closer I got to 58.25, I would probably be a seller on Verizon until I could see that breakout. We've had multiple tops now and failure to get through 58.25 on a closing basis.
All righty. How about our final one, Disney?
All right, Disney, nice breakout, getting through the 113.80 area, 113.90, whatever that is. We have pulled back. I like today, getting some buyers stepping in after falling back down a little. Off the uptrend, we had a reversing candle, so I would have expected something lower today, and we've seen that. But here's your uptrend. There's your bearish engulfing candle, and we went lower today. A bearish engulfing candle doesn't necessarily mean we're going to come all the way back down to this prior low. It just means that for me, short term, very short term, as in next day, I would be looking for lower prices. And Disney did that earlier today. I think the overall chart here looks okay. The PPO is looking strong. But when you look back over the last 6 months, we're mostly sideways. So we really haven't participated in this huge rally the way I would have liked to have seen with Disney. I mean, we did off the bottom through the second week of January. Since then, we're almost flat with where we were 7 weeks ago. And in a market that's been going up nonstop, that's telling me we've got relative weakness. I think Disney's a hold. I'm not excited. I'm certainly not jumping in from a long perspective, but I'm also not necessarily from a long-term investor standpoint. I'm okay with the way it's trading.
All right. That does complete the 10 in 10. Here are the symbols that we did just go over. You'll find those charts exactly as annotated in the Market Watchers Live chart list. To get there, just go to the Articles Blogs tab, click on the Market Watchers Live blog, and the link will be right there at the top. But I also include them on all of the Market Watchers Live recaps as well. All right, let's take a look at what's been going on in the market while we've been having fun with our final market update. All right, and here we go. Dow Jones, really most of the major markets are really flat today, most. You can see Dow Jones is up slightly. It's been in the negative most of the day. S&P 500 also pretty much consolidating sideways. It's currently down 58 cents. NASDAQ also down just a hair here, 0.2% on the decline. The problem I'm seeing right here is the S&P 400, those mid caps continuing a declining trend, a slide there. You can see the same on the Russell 2000. So in the past 2 days, they really, both of them have taken quite a hit. And the fact that there is no hesitation in the continuation of this decline on both of these, I think is a little bit of a warning sign here. I do not like to see the mid and small caps turning and not having a good day when we're at least consolidating sideways with the larger caps. Notice that TSX, Canadian markets have stayed pretty much in the positive territory all day. Right now is testing yesterday's close, but up 6.85. We've got the treasury yields down on the day, big gap down, moving sideways since then, but we're at 2.639% currently. And we've got the volatility index. It's unchanged right now, but we're only oscillating here between like 1450 and 1525. Both of that whole area of readings is still showing some complacency, I would say, out there. Dollar having a really bad day. You can see already in the slide here for UUP down almost 1/3%. GLD gold, interestingly, has not followed the pattern of UUP. Usually we'll see the exact opposite because of the way that they are related. And we're not seeing that. And I think this is also really points out on some of my gold charts that I have that the dollar and gold are really not correlated right now. They should be, but they're really not. So they can travel in the same direction. GLD is down 11 cents, 125.26. USO mostly unchanged after taking that huge slide yesterday, right near yesterday's close. It's up 2 cents right now at $11.59. TLT, big gap up, has been a little bit volatile since then, but it is up 41 cents at 121.62. And finally, a quick peek at our indicators here for the sector summary. Just go very quickly over here. And there we are. And you could just call that up. And as you can see, the only ones in the positive, consumer staples, technology, and energy, kind of an interesting ragtag group there at the top. Utilities and comm services are the laggards, including healthcare, which is down, all three down over 1/4%. All right, Tom, passing it to you, and let's go.
Great. I just wanted to pull up my blog article for a minute because I do think that we're going to see some short-term selling. I'd be really surprised. We talked about the overhead resistance on the S&P 500. We had that reversal yesterday. So I have definitely gotten a little bit more cautious in the near term, just raised more cash. And when I looked, I mentioned earlier in the day, one of the things that bothers me, and you can always find something about the market. If you look hard enough, you'll find something that goes against everything else that you're seeing in the market. So I believe the market has recovered. I don't think we go back down to those recent lows, but there are some problems. I mentioned the 10-year treasury yield at the top of the show, and I wanted to just bring up this transport versus utility chart because normally what we see is when the stock market is doing very well and things are supposed to strengthen. If the market is anticipating strength in the economy, typically what we see, and it doesn't go exactly day to day, hand in hand, but normally what we see is transports outperforming utilities in a good market because transports, if the economy strengthens, obviously there's more delivery of goods. And so transportation stocks should do well. And if the economy's strong, usually interest rates are moving up. The yield is normally moving up, and that normally is bad for utilities. So when the stock market is doing well, usually this ratio kind of goes along for the ride, maybe consolidates, but for the most part goes higher. Here over the last 2 years, you can see we topped on this ratio back in June. And if we look at the recent highs and the recent lows, there is actually the same slope. So we got this channel, this down channel that's in play. So currently transports relative to utilities are moving lower, and that can be a problem for the market. So this, along with that 10-year treasury yield, which is struggling, and I saw in your last update, Erin, continues to roll over. These are two of the bigger problems I see with the market right now. I mean, for those who maybe are in the bearish camp looking for a little fuel in the tank, I think these two might give you that. I'm not saying that the market's going to roll over and we're going to head back to those December lows. I don't think we're going to do that. But it does look in the short term, especially based on the reversals we saw yesterday. I would not be surprised to see the market, the equity market, struggle here over the next couple of days. And I know that's a little different than what I said on the show yesterday, because when we had to give our sentiment, for that poll, I said I thought the market would end higher this week. But that was before we saw all that selling continue in the afternoon yesterday and the small caps go negative and so forth. I would actually think that if the market's going to pull back, it'll probably pull back based on some of these signals that we're looking at here. Okay, so let's head into the final segment. This is a new segment called Tops and Bottoms. I'm going to focus on tops because the market's been going straight up, and I think there's some things that look a little toppy to me. And I spoke about the transports and how that ratio is not lining up, and of course 10-year Treasury yield. But I'm going to take a more specific look at some of the areas in stocks that I think could be vulnerable if the market sells off. The first is the XLRE. This has been one of the best performing areas of the market, but as we've been moving up here, as you can see, we do have a downward moving PPO. So we're seeing negative divergence. Yesterday, look at that reversing candle. Bearish engulfing candle with a negative divergence. I'd be real careful in real estate. I would ring the register and take some profits. Some individual stocks within real estate I'll go through quickly. HCP, most of these are REITs. You can see higher prices, lower PPO. If it loses that 20-day, we could see the selling begin to pick up quite a bit. Essex Property Trust, ESS, same thing. Higher prices. Look at that reversing candle. Bearish engulfing candle, lower PPO. This one looks like it's running out of steam. UDR, this is United Dominion. Maybe you're starting to see a little theme here. As we're moving up, you can see that PPO rolling over. And when we were doing this before, by the way, and that PPO started to roll over, you can see what came down the road. And I'm not saying we're going to see that kind of selling, but I think that is the risk that you have to consider if you're on the long side, stocks like this. SBAC, higher prices, PPO rolling over. Could be a problem. We're right now trying to hold that 20-day. Look at the volume picking up on the recent selling on SBAC. PLD, this is Prologis. Same thing, higher prices, PPO rolling over. This one even showing a little bit less volume too as we move higher, and that can be a problem. The last one I had with the real estate group, and there were probably others that I certainly could point out, but AIV, Apartment Investment and Management Company, higher prices. Look at that PPO rolling over and trying to hold on to support. If we fail, negative divergence, I look for 50-period test. Also, you've got this price support level that we broke out above back in at 47.50. That was their prior resistance. Now it becomes support. So as the 50-day comes up from underneath, this 47.50 area could be a really solid area of support if AIV breaks down below the recent lows. All right, let's pull up the broadcasting area. We mentioned Disney a minute ago. Well, here's the broadcasting stocks. This is kind of what I look at when I'm trading. If I have a broadcasting stock and I look and I see a reversing candle at an area where we have seen prior tops, I have to assume in the near term we're not going to break out. So if I own broadcasting stocks, this is where I might want to exit, take some profits, raise cash, and wait and see whether or not we can get that breakout or whether we pull back. If we pull back, I don't want to ride with it to the downside. So what stocks within this space could be in for short-term trouble? Well, Comcast continues to rise. It's actually up today, a nice, another 0.5%, but it's getting very close to a top that it set back in November between 39 and a half. Today's high was 38.84. So we're getting closer and closer to a key area of resistance. If the group pulls back, it's going to make it hard for the stock to make a breakout. SJR, this one looks particularly weak to me. Here's a high, here's a high, here's a high, and each time we had a lower PPO, and the PPO remains dropping here. Last move to the upside, we did see a little bit of a pickup in volume on the breakout, but otherwise, during this rally, we had very light volume. I don't know. It just looks to me like this one is running out of steam. And again, being part of a group that looks like it could be topping, I think SGAR is one to keep an eye on to possibly to the downside. AMCX. Now, this one, you look at it and it's going sideways, hasn't made a breakout. So technically, it doesn't have a negative divergence. You have to have a higher close in price along with a lower PPO reading. So we don't have that higher close. But if we pull up this on a relative chart, AMCX, and take a look, you can see that it is struggling. So here's the group topping at prior highs, and you've got a stock that is a relative laggard that couldn't get through these prior tops. If this level fails to the downside, I'm going to say around $60, I think AMCX could really start to sell off much more rapidly, could accelerate to the downside. All right, next group that I would be careful of, and by the way, most of these areas outside the real estate, these are going to be discretionary areas of the market. And if I pull up, let me just pull up the XLY, we'll come back to this. The XLY, you can see, has really struggled after the sell-off in October. The move back up in November was right up close to this 112 area, and that's where we reversed yesterday. So I really focused on discretionary. This has been a great area of the market. I'm a big fan of discretionary, and I've been trading a lot of the discretionary stocks, but this is an area where I wouldn't be surprised that we get a little bit of a pullback. So that's why I'm focusing the individual areas within consumer discretionary. Media agencies, though, here's some tops up at about 605, 610, trying to get through here, failing, pulling back. I think this is a group that could be in trouble near term. A couple of individual stocks within the group, LIVX, and this is not a high volume stock. This is actually pretty low volume stock, but I wanted to point this one out because this scares me when I own a stock. If I get a stock that gets up to 7.25 and the prior resistance level on a closing basis is 7, I have a clear breakout and volume is accelerating. I want to confirm that breakout on the close. When I see a long tail up above that prior high and I pull back down, I would be a seller. And I know sometimes you think, well, the stock was 723 earlier. I don't want to sell at 677. Well, if it goes back down to $6, you're going to wish you sold at 677. I don't like it when I get false breakouts. So I wanted to point that out. IPG, another one that is getting close to some key overhead resistance between 24, 24 and a half. Yesterday we hit 24. I think this is another one that's probably got limited upside. Pull back down closer to 22 and, I don't know, 2280, 2290 kind of makes sense to me. Specialty retailers. Let's talk about this area of consumer discretionary. Now, I'm a fan of specialty retailers. When I did the break it down segment, this is one of the areas that I thought was very strong. But if we stretch this chart out to a year and update, you will see, look at these tops coming across here at 1700. Now, we can assume that we're just going to go flying right through 1700, but I can tell you from a technical perspective, that generally is not a good thing to assume. You've got sellers that have appeared here over the past 8-10 months, multiple times, and until we can break through this level, I would assume that we're going to see sellers again. My guess is we're going to go down, test the 20-day, and then break out. But we shall see. We got up above 1700 yesterday. We failed, and we're coming back down. So what stocks within specialty retail could be in trouble here? Well, Dick's Sporting Goods. Look at all the tops between 38 and 39. Have not been able to close above 39. Last 5 days, we've been above 38, and we're just sitting here. I expect probably going to make another run to the downside. How about Office Depot, ODP? Check out the overhead resistance at $3.40. And by the way, there's your false breakout that I was talking about earlier. Got a clear breakout intraday above these prior highs. We fail. Look what happened to the stock after that. That's why if you see that false breakout, I think you're better off being safe rather than sorry and moving to the sidelines. But we've had a number of tests recently of this 340 level. We've moved above intraday. Can't get the breakout. I think this one could struggle if specialty retail drops. LAD, this is Lithia Motors. When you look back to the gap down, the reaction high here was up just above 90. We just recently got back up above 90. These prior lows coming across here were at 92.50. Just seems like this 90 to 92.50 is going to be a difficult area for Lithia Motors. All right, gambling stocks. Gambling stocks look like they've got a change of character here, been downtrending, now broken back to the upside, but struggling here, printed a higher high with this PPO declining. So I think we could have some issues in gambling stocks. ERI, El Dorado Resorts, very close to overhead resistance near $50. Want to be careful there. Higher prices, lower PPO, negative divergence, approaching resistance. That's normally not a time I want to take a chance on the long side. MLCO, this is Melco Resorts, reversing candle yesterday. Look at that negative divergence. Higher price, lower PPO. I would expect weakness here. And Wynn Resorts, WYNN, another one, higher price, lower PPO. I think with that reversing candle yesterday, we could see some weakness, perhaps down to the 120 level, and then we'll see from there. Last group I have is clothing and accessories. Just a couple of stocks here, but clothing and accessories trying to get through this 330 area. PPO turning over. Another one that could be in for some trouble. Fossil, FOSL. Look at the downtrend. It gapped down with earnings, made its way all the way back up to the recent highs in between 16 and 17. That's where we had prior support before the gap down earlier in February. And 16, 17 has been a wall trying to get through over the past few weeks. So this stock is reversing, looks to possibly head back down again. Funko, FNKO, moving higher, but check out gap resistance. Look at the huge volume back in November. We gapped down from $20. We're at $20 right now. Now, the PPO here doesn't look bad. Volume has picked up a little bit, but I'd feel better on a 20-day test here than trying to get this breakout above gap resistance. And lastly, G3 Apparel Group. You can see the gap down here with heavy volume. Look at today's move. I do not like that long tail and failure. I would suspect that GIII is heading lower. Let's pull up that quick summary, and then we will wrap up the show for you. Mm-hmm. There is the summary. And I'm not saying that I'm bearish the market. I've actually been pretty bullish recently. I think that this is needed. We're very overbought. We can look at a lot of different time frames there, and I think just about everybody would agree that this market's come a long way in a fairly short time. 19% in 2 months on the S&P. That's pretty big.
Yes.
So, I think it's, you kind of get into this thing where you just believe the market's just going to keep going up, but it really does need a pullback. Some consolidation, I think, would be healthy.
Absolutely. All right. Well, we did have one question for you that came in today on your actually yesterday on your price relative chart. So I'm going to just pull that up real quick here.
Okay.
And the question was, Tom, why don't you use a 200-day moving average on this particular chart?
Well, I don't use 200-day moving average because I'm a short-term trader and I'm trading momentum. By the time a stock gets to its 200-day moving average, there's no positive momentum in the stock. I mean, 200-day moving average is going to be in an uptrending stock, the 200-day should be way below where I would ever hold a stock. So I don't trade off of 200-day moving averages in an uptrend. I trade off the 20. You get a negative divergence, you can drop to the 50 to reset, but rarely in an uptrend, and I'm going to say never in an uptrend, would you go all the way down to the 200-day moving average, at least not a short-term uptrend. Mm-hmm. Now, somebody looking at a longer-term chart that pulls up maybe a 10-year chart, you'll see that occasional hit of the 200-day moving average. But I'm, like I said, much more of a short-term trader than that.
Well, what's interesting is that somebody asked, you said you're a short-term trader. How long is your average trade? I mean, how long are you in something?
Well, either until it breaks down. I had JBHT, and literally it was out the next day because it didn't hold the 20-day yesterday. So I held that less than 24 hours. If a stock works out for me, if it hits my target in a day, I'll sell. But normally in a normal market, it takes a while to move back to the upside. So I would say my average holding is probably a couple of weeks to maybe two to 5 weeks, probably normal.
Excellent.
All right. There is your upcoming schedule. You can see we got a lot of good stuff coming up. Want to thank everybody for being with us today. Please remember to complete the survey as you exit. It is located just below your video player. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Tuesday afternoon, everybody. See you back here tomorrow. Happy trading.